Most people do not misunderstand money because they are unintelligent. They misunderstand it because they have been trained from their first paycheck to track the wrong number. They open their banking app, they see a balance, they see a deposit from their employer, and they believe they are looking at their financial reality. This is the great illusion of modern economic life. The salary is not your wealth. It is not your power. It is not even your money in the truest sense. The salary is merely a single stream of money that flows to you in exchange for your time, and it stops flowing the moment you stop trading that time. This is the fundamental error that keeps the majority of people financially fragile, regardless of how large their paycheck becomes. The wealthy, the investors, the bankers, the owners of private equity firms and family offices, they do not think in terms of salary, they think in terms of cash flow. And until you understand why this distinction is not semantic but structural, you will remain a passenger in an economy that is driven by those who own the engine. To grasp this, you must first separate the idea of income from the idea of financial control. Income is what you receive for labor. It can be generous, it can be prestigious, but it is always a transaction with a single point of failure: your employer, your health, your industry, the economic cycle. Any one of these variables can reduce your income to zero with almost no warning. Cash flow, by contrast, is the net movement of money into a system you own and control. It is the profit generated by assets you have deployed, whether those assets are rental properties, dividend-paying stocks, operating businesses, or debt instruments. When you own a cash-flowing asset, you are not selling your hours. You are selling the use of capital, the use of space, the use of a brand, the use of intellectual property. A landlord does not work for their tenants. They provide a service, but the money arrives whether they are at their desk or on another continent. A shareholder does not contribute labor to the corporation. They contribute capital, and the corporation rewards them with a portion of its profits. This shift from labor-based income to capital-based cash flow is the single most important transition in the financial life of any individual. It is the difference between being a participant in the labor market and being a participant in the capital market. It is the difference between swimming in the current and owning the river. This is not to say that cash flow is effortless or guaranteed. The assets that generate cash flow carry their own risks, and anyone who pretends otherwise is selling you a fantasy. A rental property generates income only when it is occupied, only when the tenant pays, only when the roof does not leak, and only when the property taxes do not rise faster than the rent. A dividend-paying stock can cut its dividend overnight if the company's management decides to preserve cash or if the industry faces a downturn. A small business can see its cash flow evaporate when a competitor enters the market or when a key supplier raises prices. These are real risks, and they are the reason that cash flow commands a premium. The wealthy do not avoid these risks. They manage them. They diversify their streams so that a single failure does not collapse their entire financial structure. They stress test their assets against rising interest rates, falling occupancy, and shifting consumer behavior. They build margins of safety into their calculations. This is the difference between the amateur who buys a single rental property because they heard real estate is a good investment and the professional who evaluates the property's net operating income, its capitalization rate, its debt service coverage ratio, and its sensitivity to market changes. The amateur sees an asset. The professional sees a cash flow machine with a known set of vulnerabilities. The architecture of this machine is built on a few essential components, and debt is the most powerful of them. In ordinary personal finance, debt is framed as a burden, something to be eliminated as quickly as possible. In institutional finance, debt is a tool for amplifying returns on equity. This is called leverage, and it is the engine behind most large-scale wealth creation. Consider a simplified example. An investor acquires a property valued at $1 million. They contribute $200,000 of their own equity and borrow the remaining $800,000 at an interest rate of 4%. The property generates $100,000 in annual net rental income. After paying $32,000 in interest, the investor is left with $68,000 in cash flow on their $200,000 investment, a return of 34%. If they had purchased the property with all cash, their return would have been a modest 10%. The debt has multiplied the cash flow. But this is a simplified example. In reality, the investor must account for principal payments on the mortgage, which reduce the cash flow available for distribution. They must account for vacancy, which might run at 5% of gross rents. They must account for repairs, insurance, property taxes, and capital expenditures for major replacements like a roof or a heating system. They must account for property management fees if they do not manage the property themselves. And they must account for refinancing risk. If interest rates rise when the loan matures, their borrowing costs increase, potentially turning a positive cash flow into a negative one. The professional investor models all of these variables before they commit a single dollar. They do not hope that the cash flow will appear. They calculate it, they stress test it, and they structure the deal so that the cash flow can withstand significant shocks. This is precisely how private equity firms operate on a much larger scale. When a private equity firm acquires a company, they do not simply write a check for the full purchase price. They structure the transaction using a significant amount of debt, often provided by a consortium of banks. The acquired company's existing cash flow is then used to pay the interest on this new debt. The target company, in a very real sense, pays for its own acquisition. This is the essence of the leveraged buyout. But it only works when the target company has stable, predictable, and sufficient cash flow to service the acquisition debt. The private equity firm is not betting on the company's stock price. They are betting on its ability to generate cash year after year, regardless of market volatility. They will often restructure the company to improve its cash flow, selling off underperforming divisions, cutting costs, and optimizing operations. They are not passive owners. They are active managers of cash flow, and their entire incentive structure is aligned around maximizing the stream of money that flows out of the business. This is why they pay themselves through dividends and distributions, not through salaries. They are taking their returns from the cash flow they have engineered. This is not a secret. It is the public record of how private equity has generated extraordinary returns for decades, but it remains opaque to most people because most people have never been taught to look at a business through the lens of cash flow. The banking system itself is built on this same principle, acting as the central intermediary for the flow of capital. A bank does not simply store money. It takes in low-cost deposits, which are its primary source of funding, and it lends that capital out at a higher interest rate to borrowers. The difference between the rate it pays depositors and the rate it charges borrowers is the spread, and that spread is the bank's core cash flow. This is why banks are so sensitive to changes in central bank interest rates. A small shift can compress or expand their margins dramatically. It is also why banks are deeply embedded in the real economy. They are not passive observers. They are active underwriters of risk, evaluating the cash flow of borrowers to determine whether they can service a loan. When a bank lends to a corporation, it is not evaluating the corporation's stock price. It is evaluating the corporation's ability to generate enough cash flow to make its interest and principal payments. This is the discipline that underpins all credit. The bank is a cash flow expert, and its survival depends on its ability to assess the reliability of other people's cash flow. This is the lens through which the financial world views money. It is not a static number on a screen. It is a dynamic flow, and the institutions that control the flow control the economy. This perspective extends to the highest levels of wealth management, the family office. The modern family office is not a bank account for a rich family. It is a holding company for a diversified portfolio of cash-flowing assets. The family office does not diversify for the sake of diversification. It diversifies to ensure that its cash flow is resilient against economic cycles. When one asset class underperforms, another stream, perhaps from a bond portfolio or a stake in a recession-resistant business, continues to generate cash. This is the opposite of the ordinary investor who buys a stock because they hope it will appreciate in price. The family office buys a business because it has a proven history of generating free cash flow, the profit left over after all expenses and capital investments. This free cash flow is the true prize. It can be reinvested into the business for growth, distributed to the family as income, or used to acquire additional businesses. The great financial dynasties, the Rockefellers, the Rothschilds, the Walton family, were not built on salaries. They were built on controlling the cash flow of entire industries. John D. Rockefeller's Standard Oil did not just refine oil, it controlled the logistics, the pipelines, and the distribution, allowing it to extract maximum cash flow from every step of the value chain. The Rothschilds did not just lend money. They created a network of information and capital that moved money across borders faster than anyone else, capturing the arbitrage in every transaction. They were not merely wealthy. They were architects of the current. The tax system in the United States is structured to reward this behavior, which is a structural advantage that few ordinary people leverage effectively. Income from labor, wages, and salaries is taxed at ordinary income rates, which can reach the highest marginal brackets. Income from long-term capital gains and qualified dividends, which are the primary forms of cash flow from equity investments, is often taxed at a lower rate, depending on the taxpayer's income level and holding period. The government does this to incentivize investment because investment drives economic growth. But the effect is a widening gap between the tax burden on the worker and the tax burden on the owner. When you earn $100,000 in salary, you are taxed at the marginal rate for ordinary income. When you earn $100,000 in qualified dividends, you are taxed at the lower capital gains rate, often saving tens of thousands of dollars in taxes. This is not a conspiracy, it is a policy choice. But it is a policy choice that benefits those who understand how to generate cash flow from assets rather than from labor. The wealthy use this system aggressively and legally. They structure their affairs to maximize the portion of their wealth that flows through the more favorable tax channels. This is available to anyone who has capital to invest, but it remains unknown to many because they have never been taught to think in terms of cash flow. For the ordinary person, the practical implication is clear. You must systematically restructure your personal economy to prioritize cash flow generation. This begins with eliminating negative cash flow, the consumer debts that drain your personal current. Credit card balances, auto loans, and high-interest personal loans are not just expenses. They are liabilities that reduce your ability to generate positive cash flow from your income. Eliminating them is the first step. Once the drain is removed, you can begin acquiring cash flow positive assets. This might begin with a dividend-paying stock in a stable company. It might be a rental property, carefully evaluated for its net operating income and debt service coverage. It could be a small online business that generates a monthly profit. The nature of the asset matters less than the principal. It must pay you more than it costs you to own it. The cost of ownership includes interest, maintenance, taxes, insurance, and opportunity cost. The cash flow is the difference. As you build a portfolio of these positive streams, you are creating redundancy for your primary source of income, and eventually, a replacement for it. This is the journey from vulnerability to security, from trading your time to owning the results of your capital. It is a shift in identity, from worker to owner. This is not about greed or becoming a caricature of a wealthy person. It is about understanding that money is not a reward for effort. It is a tool for creation. And the most powerful tool in financial creation is the consistent, reliable, and growing stream of cash flow. A person who controls $1 million in cash-flowing assets is more secure and more free than a person who earns $1 million salary, because the cash flow does not require their physical presence. does not require their health, and is not subject to the whims of a single employer. It is a machine they have built. This is the true meaning of financial independence, not a vague number in a retirement account, but the ability to generate enough cash flow to cover your living expenses without selling your time. Once you reach this point, you are no longer a participant in the labor market. You are a participant in the capital market. You have graduated from being a consumer of money to being a producer of it. In the end, cash flow is the master key to the financial world. It explains why a business that is losing money under accounting standards can be valued at billions of dollars if it has growing free cash flow from subscriptions. It explains why a bank that is technically insolvent can survive if regulators are confident in its future cash flows. It explains why a family can own a piece of land for 200 years without working a day on it, simply by leasing it to farmers and developers. It explains why the modern economy is built not on savings, but on credit, which is nothing more than a bet on future cash flow. The world of money is not a static snapshot of who owns what. It is a river system, and the wealthy are not just the people who own the biggest ponds. They are the people who own the dams, the pumps, and the pipes that direct the flow. They understand that the money will always go where it is treated best, where the flow is fastest, and where the control is most concentrated. The salary is a pool, the asset is a river, and the river, in the end, always wins.